Here's a brief history of how we got to where we are today. 5 billion years ago, Earth was created. A couple million years ago, humans started walking around with something that looks very similar to the brain that we have today. About 30,000 years ago, those humans started creating something today that we would call art. About 10,000 years ago, those same humans started doing something called agriculture. Now, pause for a second. Isn't it interesting that art and creating paintings on the side of cave walls happened 30,000 years ago, started 30,000 years ago, but agriculture only started 10,000 years ago? This is just a small glimpse into just our human brain and how maybe always a logistical way of thinking about things is not always how, I didn't really actually mean to say logistical, but a logical way doesn't always work when talking about the human brain. Okay, and then fast forward, we get agriculture 10,000 years ago, and the population just absolutely booms on this planet. And now we're going to really fast forward to about 120 years ago, where in a country that wasn't that old at the time, okay, about 120 years old at the time, the country's called the United States of America. About 120 years ago, that country started kind of officially a stock market in 1896. Yeah, so let's keep going. Now, over the last 120 years, that stock market has gone up or down, but generally speaking, if you look at 120 years of the stock market, that price chart is going up and to the right. Anyone who's in the stock market is a trend follower because the trend has been up and to the right for 120 years. Yes, there have been multiple 18-year periods where the market went sideways, but if you zoom way out and look and say, yeah, you know what? The market has been going up and to the right. So what we do know is over time, the market absolutely does grow money. Though the life expectancy in the United States is about 80 today, so carrying what the market does over 120 years, if you're only going to live 80 years, maybe doesn't have quite the same significance. But we do have a century and 2 decades to know that there are repeatable patterns in the stock market. And ultimately, the most important opinion is the actual stock market. Which leads me to today's podcast, today's episode, to talk to you about opinions and whose opinions matter most. Hey everybody, this is RC Peck, and this is my weekend podcast. This is episode number 345. And man, there's a lot of opinions out there about the stock market. I, of course, have an opinion, and there's probably 10,000, 100,000 other opinions. So what I'd like to do is look at maybe one of the most important opinions out there today about what is going on with the stock market. And the stock market, or the specific index that I'm going to look at, is the S&P 500 index. Partially because I live in the United States, but also partially because it is the most followed index on the planet. It's the most watched index on the planet, which is the S&P 500 index. So here is the S&P 500. It is going back 4 years, or the price chart is going back 4 years, and I put on a horizontal line. And that horizontal line represents the price that the S&P could not get above between 2015 and the most of 2016, or I should say really the first half of 2016. But here's the thing, it did break out and above. And what I want to do is I want to zoom in on the last maybe year, maybe less, just to show this breakout, because there's a lot of opinions going on right now of what should be happening and what is going to happen. So you know what? Why don't I just throw one more opinion in there? Now, part of the opinion is my interpretation of the opinionated person or entity, and part of it is just what I think is maybe more evidence. And so the opinion I'm going to talk about is the opinion of the S&P 500, which generally speaking is about a $20 trillion index. And there are hundreds of millions of people's money, lives, futures, portfolios in the S&P 500. So there are hundreds of millions of opinions on that line. And that, in fact, is the line that you're looking at. It's a line of people's opinions on whether they believe the future is getting better or the future is getting worse. So as I zoom in, and this is the only other price chart I'm going to show today, Now look at what happened. This is the S&P 500. I just zoomed in on it, okay? We had the Brexit, which is this whoop-de-doo here in June. Market fell 5%, then the market came right back up 5%. Okay, so the Brexit was basically telegraphed for 18 months that it was going to crush everything. So far, the only thing it looks like it's crushing, and that's a very interesting word to use, crush. The only thing it looks like it's really hurting right now is the actual Great Britain bond. It's hard for me to say that. The pound, the Great Britain pound. My tongue is tongue-tied today. That is falling, but the actual stock market in Great Britain and Europe and the US, they all tell very different stories. So Brexit came along, nothing happened, right, relatively speaking, and the US S&P 500 broke out to the upside. Okay, and now it just kind of stalled, but it had a huge move up. I mean, look at this. It went from 2,000 to 2175. Maybe just let's round up and be generous and say it went up 9% very, very quickly. And so now it's just kind of digesting this huge move. Now, should it have gone up? I don't know, guys, but it did. And there's hundreds of millions of people that are voting with their real money in the S&P 500. And collectively, what they said was, you know what? Maybe things aren't as bad as we think they are about the future. And so the market moved higher. Now, should it have moved higher? I don't know. Should it correct? I also don't know whether it should correct. What I would like to see is for the market to correct down to where it broke out, which is about 2132, 2140. That would be about a 4%-ish drop down here for it to test this red line here, right? Because this used to be the old ceiling that the market could not get above. And then it finally broke through that ceiling. And now I want to see, is this a floor? So if it comes down and tests this, that's going to be a very important test for it to hold. And then if it tests it and moves higher or just stays above the red line, that is a significant test. And that says there is strength in this market and the path of least resistance is higher. Now, I'm pointing this out, and a bit of this is predicting because I don't actually know what's going to happen. But the opinion that matters most, the opinion that matters most is those collective 100 million people or those hundreds of millions of people who are collectively saying, hey, is it getting better or worse in the future? Now, I know interest rates are low. I know central banks are printing money. I know companies are borrowing at super low rates and buying back their stock, and that's that's helping their stock go higher. I know all that, but so do a lot of other people, and so does the stock market, and yet it's still deciding to do what it wants to do. So the opinion that matters most is the stock market. And right now, the path of least resistance is up. And as long as the price stays above the red line, that is a vote for the future is getting better until it doesn't. Now, if the market actually does correct that 4 or 5%, during that entire correction, everyone's going to be talking about how this is the big one. This is the next big correction coming. See, I told you you should be short. Yep, you got to go short. You got to liquidate. You got to get out of everything. But it's only if it closes below the red line and stays below the red line and tries to get above the red line but cannot, then we can start to talk about like, hey, maybe this breakout is really what's called a false breakout. But until that happens, we have some time on our side to see what is actually going on, which is, maybe I'll just say this, which is the second point of my podcast to you today. We have to wait. We have to wait and see how this works. It's very tedious. Looking back in time, looking at this price chart here, we can go, yeah, that's what happened, and then it resolved itself, and then it did that, and then it went higher. But that's just in hindsight. But while we're in it, while we're living it, while we're waiting, while we read headlines in Zero Hedge and newspapers and people who are respected, who have graduated from brand name schools, say the market's going to crash, that makes us believe that that might happen. But please remember, and it does not matter who it is, they are not smarter than the market. And right now the market is saying, hey, I've broken out to new lifetime highs. Never ever in the history of planet Earth has the S&P been this high. And hey, let me just check it out up here. Maybe I'll go down and test that red line. And maybe when I test it, I'll then go back up and move higher. And then we know something. We know something that has some significance to it, that the market, in fact, is going to go higher, whether we believe it should go higher or not. Okay, guys, so what is the takeaway? So here's the takeaway. The market's opinion matters most. Not newspapers, not blogs, not my opinion, no one's opinion. What matters most is the market's opinion. I think a small correction is healthy, and I'd like to see a 4 or 5% correction and then move back up, and that would be a very strong vote of confidence that we have more upward movement in front of us. The other thing I'll just say is all the fear-mongering out there that the market's going to crash. Guys, very rarely do markets crash when everyone says it's going to crash. In fact, I've never researched a time period where everyone said this was going to happen and it actually happened. That's just not how things work. Look, the market did move higher. So whether you wanted it to or not, it actually did move higher. So you got to go with what's actually happening and not what you want to happen. And then lastly, guys, other stuff is moving higher. Now the S&P had been moving higher by itself for a while, but now other parts of the world are starting to move higher. China is moving higher. Emerging markets is moving higher. Many of the markets in Europe are moving higher. So this is just not a U.S. thing alone. When you look at other indices around the world and you notice they're moving higher, it helps to build the strength of this movement. Hey guys, this is just another step in helping you protect your portfolio and protect your future. Until next time, this is RC Peck.